What's up guys, Luis here, the Brazilian investor, and today I'm going to be showing you guys the importance of DCA into every stock and also Tesla and NIO exceptional deliveries in the second quarter of 2021. The definition of dollar cost averaging by Investopedia is simple. An investment strategy in which an investor divides the total amount to be invested across periodic purchases of a target asset in order to reduce the impact of volatility in the overall purchase. For example, let's suppose you have $1,000 to expend in an investment. Because of that, every Monday you would put $100. It doesn't necessarily has to be the same amount every week. If you like the price, buy more. If you believe it's a little expensive, don't buy that much. I will actually leave a link down below to a great article that is called Even God Couldn't Beat Dollar Cost Averaging. It will take you about 8 minutes to finish the reading. My first ChargePoint shares were bought around $40, but the price of the stock dropped to 19 per share in a matter of months. Obviously, I bought this dip, which maybe lower my average cost in my total shares. Because I added most of my 88 ChargePoint shares in the dip, my average cost is close to 26, a profit of 22% or $500. There are no words that can describe how happy and blessed I am. I haven't completed a year of investing. However, my public account is getting close to 30% profit. Not only that, but every company is growing regardless of the stock price. My investments are on track. I know that. NIO, for example, delivered roughly 22,000 cars in Q2, which is an increase of 111% compared to last year. More than 8,000 cars only in June were delivered, an increase of 116% year over year. So guess what happened to the stock? It dropped. People love to buy the rumor and sell on the news without thinking long term. I don't mind, as I always say, these are just buying opportunities. Tesla was able to deliver more than 200,000 cars in the second quarter of 2021, with a production of 206,000. Remember that in 2020, Tesla delivered 499,550 cars. And now, in Q2 alone, they did 40% of what they delivered in the past year. In Q2 2020, they delivered 90,000 vehicles. In the same time frame, they had an increase of 122% year over year in 2021. Street estimates were expecting even more, which is one of the reasons why I don't care about the short term. How does a company have more than 120% growth compared to the past year, and these so-called analysts still wanted more? In my opinion, they are just trying to make the stock go down since they missed the estimates. Look at what the company is doing and not what the stock price is trading at. Both Tesla and NIO had more than 110% growth in deliveries. That's the important thing. Gary Black, one of the few analysts that actually understand Tesla, always tried to respond to the fear, uncertainty, and doubt (FUD) that the media is spreading. He tweeted, "Stocks go up when they beat expectations. Record results mean nothing if they don't meet expectations. Deliveries drive revenues and profits, not production." That's gonna be all for today, and as always, have a good one, stay safe, and invest for the long term.